Hey, and welcome to TSOB. This is a podcast for entrepreneurs who are interested in investing or starting their own funds. We are Adam Anderson and Zach Eikenberry. Join us to get a behind-the-scenes look at the relationships between founding entrepreneurs and the VCs that invest in them. Hey, welcome to TSOB, the home of the two only influencers in the very, very narrow niche space of transitioning from entrepreneurship to venture capital to screw VCs. I don't want to be one of those guys to maybe we're private equity and hey, have you thought about crowdfunding and and that whole journey brings us back to maybe we should just build a profitable company with customers who pay us. I'm Adam Anderson. This is Zach Eikenberry. What's up, buddy?
What's up, man? Happy 2023.
What? We made it.
Yeah, as Larry David points out, you don't have to be happy about it. You can just say it's a year.
Yeah,
it's 2023.
To be determined. I got some stuff to talk about today. What you got? What's going on in your world?
Oh, let's go through your hot takes because I'm coming to the table after watching venture capital as part of a capital allocator world. Like, I actually don't have a lot of prejudice against capital allocators. Like, I'd love to have the capital and access to capital to help allocate it. It's still a trajectory of mine. But the venture capital space, my respect for them has deflated watching their behaviors interacting with them over the last 3 months. And so I am happy to talk about that, but I'm coming to the table with a low view of venture today. And you mentioned that in the intro. So
yeah, I think we talked
I'd love to talk
about
I want to talk about your things then.
Well, part of it was you sent me this hilarious LinkedIn post by Matt Turck. I am having troubles reading because I don't have my readers because my kids are jerks and they hide things from me. And that just made me laugh. So that's kind of the theme I wanted to talk about today is from a industry point of view, venture capital. What are some of our conclusions now that we've seen that the world's kind of taken a shift? And then the second thing that I thought was kind of neat, I have made the decision to switch my SPV and my raise from a Reg B to a Reg C. And I thought that I would talk through the reasoning for the different regs that we looked at and why we made the decision. And so let's talk a little bit about VCs and then let's talk a little bit about deal structuring.
Okay, let's do that.
All right, you start, get the juice going, baby. First off, talk to me a little bit about this article you sent me that was hilarious. That was just absolutely hilarious.
Yeah, so it was this gentleman who sent on behalf of VCs their 2023 resolutions, and which is it just kind of outlines the hypocrisy of the VC space, right? Where the VCs signaled to the world that they all wanted crypto and Web3, and they wanted highly profitable companies that were disruptive, et cetera, et cetera. And when all of those industries hit headwinds because of just the inflation and money print that we went through from the hangover from 2020 and 2021,
right?
They immediately pivot away and they remove all reference from crypto and Web3. And the only sexy space that they're in right now is they do not even care about profitability or what have you. They're leaving all these companies who built according to the parameters they put out. They said, hey, hit this target, hit these ARR, do this kind of thing. Whatever it is, whatever milestones the VC world signaled, they ripped the rug out from under founders and said, those don't apply anymore. And then they blame founders who are sitting there going, but I thought we built this off of valuations over here. And they're like, no, get with it. The world's changed, man. Valuations are down. And, we're done with all the craziness. And it's just hilarious to me that they expect everybody else to take medicine that and solve their problems for them that they created. They're not creating a soft place. They believe because they have the capital, they're paying the pipers, so they get to call the tune, and they get to decide how the world should act and respond. And they're doing it in this mindless way. And I think that's part of my saltiness about VCs is I thought venture capital attracted the best of people who are on the frontier and pioneers and trying to place bets at the edge of the economy. And they're not. They're speculators. They are all trading paper between themselves.
Yeah.
And
Well,
their only value is being able to find a founder who is a better pitch person.
yeah. Well, the thing is that, so let's talk about why that's important. The reason why it's important is the whole problem is in the promises. VCs have to make promises to LPs to get the money so that they can go out and invest. And so they made these promises on these amazing returns. Oh my gosh, if you looked at crypto, look at these returns. If you give me $20 million, I'm going to put this into different things and I'm going to get you 200 million or 2 billion back, right? And so now they've made the promise. And now it's like you said, it isn't they're going to look for good, healthy, profitable companies because that wasn't their promise to their LPs. And so the problem comes when the VC makes a promise to a VC firm or individual makes promises to their LPs and then are not transparent with that back to the venture to the companies that they're trying to invest in, right? And one of the things I like what you said. You said it was kind of a mindless thing. I think it's worse. I think it's mob mentality. I think it's just a school of fish or a flock of birds, and when one flies and changes direction, they all go.
That's right. Yeah, and because there's protection from their LPs because they compare themselves to the other VCs, other venture capital, right? Like they don't actually compare themselves to what they promised in the original deck. They compare themselves to where the market is.
Oh,
today.
that is a good point. The promise gets you in, and then they measure everyone else. Interesting.
Yes. Yeah. So
I'm the most attractive man in my house.
That's right. That's right. I think it has to do with my own personal journey. When I was first starting out in entrepreneurship, I made the mistake of wanting to talk to banks. Kind of like, why rob banks? Because that's where the money is. And I thought, oh man, and they have these startup programs and they talk about like wanting to help small businesses. So all the marketing around banks is designed to think that it's there for you, Mr. Entrepreneur. And it's not.
Aww.
Right. And that was a world crashing down event, right? Where as much as banks want to promote and they are highly regulated, they have a whole series of stakeholders that are not you, Mr. Person looking for credit or loan or what have you, unless you want to put your money with them and be a depositor. But even then, you get no say. All the regulators, all these other people, the LPs of the bank get the say. And it was just a crashing reality for me to realize that no banker could ever do anything for our business.
Yeah.
The best I could ever do is build a business that used banks. Otherwise, and I think I said, well, there's a frontier out there, and this frontier is venture capital. These are, Ivy League graduates who are doing cool stuff. They're all really smart, what have you. And I had this veneration, especially for like operator-led funds, people who are former operators who got into the VC world. And I think that's the reality that's really shook in this last 3-4 months. Because in all honesty, whether or not signatures were traded, right? We had planned weddings and picked out wedding dates and venues with about 3 firms. And even though they never
Right.
formally proposed and did all the things. Like, we knew that the proposal was coming around the holidays when all our family was in town, and we had already picked out the wedding dates and all the stuff, like I said, as the metaphor continues. And we had built a life and a plan around that. And when those things fall through, like at a certain point in time, you're going to step back and say, hold on, am I really trying to marry the right kind of person here?
So you went from, and this is the emotional journey. You got left at the altar, and you're there, and I'm picturing you as the bride, by the way, because I like the idea of you having this amazing beard, and like the veil comes off, and it's like, anyway. So you're at, and you're like, they left. Oh no, they never showed up. They told me to be here, and then you're like, is it me? And then the next one happens, and you're like, oh, it's me. It's got to be me. The third one happens. You're like, oh my gosh, it's totally me. I'm. And then eventually it happens one more time, and you're like, I should stop dating assholes. It's like, oh, you're attracted to the kind of VC that leaves you at the altar, right? And so you still have responsibility, but it's not your fault.
Yeah. I think that's largely where I am. And I do think there's going to be a capital hangover in the VC space. So I'm part of my internal satisfaction. I think there should be more capital allocation around the fringes. I actually don't think as an economy we put enough towards new technologies, new opportunities, entrepreneurship, etc. I think we put far too much into other asset classes, and we don't put enough into this asset class. I believe that from an economic, academic worldview. When it comes to the practitioners, though, there are zombie funds now that are led by people who should not have raised capital.
What do you mean by zombie fund?
A zombie fund is somebody who has too much money to die.
Oh, shit.
And so they're a zombie. They walk around trying to take their marks, slowly writing checks, living off the 2%. Excuse me. Buying the Patagonia vest and still, flying first class, going to conferences, sitting on panels. And what makes me pissed off about zombie people is the gurgling noises they are going to make when sitting on panels in front of founders saying this is the new reality. The new reality is 2 to 3x ARR. Yeah. And they're going to be like, the world just shifted, guys, and everybody needs to get with the new reality. And the new reality is 3x participating, and investors are going to want more control. And this is just reversion to the mean. Back in the 90s, you all would have been thrilled with these terms.
And like that, yeah.
And that's just going to be the mindless dribble that comes out of the industry because there's these non-thought leader, non-strategic capital allocators sitting at these funds who have no incentive. Like, I think there's a couple of good funds out there. Don't get me wrong. I think there'll be a bifurcation because 1x loss on your money is not as important as getting 100x return.
That's right.
But I think VCs are going to be scared, and they're going to wait for some VCs to start putting their head up and making bets, and they'll know where to put all their checks and towards.
Well,
and they're going to outsource their diligence because they're too scared to actually. It's a speculator's game. They don't know where the next gold rush is. They're going to wait and see. And so what's frustrating for companies like Hook, if the reality is thus, and don't get me wrong, there's probably an exception. There's probably a venture firm out there that'd be a great person for us. We just haven't met them, talked to them, put them in our pipeline, anything like that. Like what I've started to believe now is if we need capital, it's going to have to come from a closely aligned private equity or a group of like super angels who believe in our mission, who don't have LPs behind them and dictating what they do. They're not strung in that way. And they want profitable ATMs. That's what they want. That's what we built. And venture's not looking for a profitable ATM right now.
Yeah. So, again, it gets back to the promises. The VCs are promising that 100x. And so a profitable ATM doesn't give the 100x. And we get frustrated when we're like, dude, now let me rephrase that. You can have a profitable ATM. And also, if you're in the right market and you're creating the right product and you have the right disruption, you create that 100x. So whether or not you're profitable or not doesn't mean you're going to get that 100x. And so the thing that really confuses me is how you can be a profitable, we print money ATM, and you're in the right markets and you're doing so. But
there's no more right. So
there's no more right.
If you, let's say you raised your fund in early 2021, it's probably a 10-year fund, right? And so you try to write a couple of checks to get opportunities at fund 2 because you're like, okay, this spigot's going to turn off at some point. You know that, you just don't know when. And so you're in 2021. If you hadn't already started trying to raise fund 2 for follow-on capital and the like by end of 2021, you probably felt the pressure to stop and make things last. Or you had hangover into, let's say Q2 2022 is the last time you got a second fund.
Sure.
It doesn't matter. So your first fund expires in 2031 and your second fund expires in 2032. So what you can do right now is to hell with founders and this narrative that the best companies grow in a recession. Is you don't have to believe that in practice. You can say it on stage, but you can sit there for 2.5 years on your hands looking at deals, sharpening your knife, getting on jets, going to conferences, nurturing the 6 companies you bet on in 2021.
Yep.
You can do that without penalty right now. And you can do that through 2024. And that's my point. As a founder, I get frustrated because I had believed a larger narrative that had no backing to it. It didn't matter what operationally I was able to accomplish. Now, it doesn't resonate with anybody who's going to sit on their hands for 2.5 years. Now, don't get me wrong. In order to keep deal flow going, they have to tell you that they're still writing checks. They'll let their junior analyst basically lie to you. Yeah. And they'll just say, however, it used to be diligence was 30 days. It's really like 90 days now, and et cetera, et cetera.
Yeah.
And they're not.
This is what I hear you saying is we've been playing a game under a certain set of rules and we were wrong about the rules. And so whoever was explaining to us and the rules changed in the middle of it. But if I go back to, like, I enjoy bitching about all this, but then my head goes, well, what's the solution? And what keeps going through my head is the VCs aren't the problem. The VCs do what the LPs tell them to do. Now, there's a subset of them that, of course, have a disproportionate amount of power, But if you have dumb money being handed to somebody, like if you have a huge endowment being given and it's just dumb money sitting there and you've convinced somebody, right? I think that if you want more investment on the fringe, then you need a more educated investor class that funds the VCs. And there is like the work that we're trying to do up in Charlotte. It's wonderful. I love those the guys who are with Charlotte Innovation. They're tackling this problem in such a cool way because we were sitting there and they said, yeah, we need to build another unicorn. And I was like, nope, you need 1,000 $10 million companies to be born here and to stay here and have that happen over the next 20 years. And they're like, you're absolutely right. We need ATMs that print cash and hire people. And that's how you do economic development. And that's how you do da. And then we turn around and we say, and this is where it all fell apart and where they're fixing it. Great. All we need is these real estate investors to start investing in this stuff instead. And so if you look at the source of the money, if you look at the source of the LPs, The limited partners who are deploying capital into the funds are coming in, and they've been listening to the same crap that we've been listening to. So they have expectations on returns. They have expectations on how the funds are supposed to operate. And at the end of the day, there needs to be a wake-up call, and there has to be an alignment of goals, meaning what do we want this money to actually do? How do you want to get money to be returned to you and whatnot? And my hypothesis is that individual investors that do not have a mission for their money are probably not the right answer. Because they're going to want maximizing their returns. They don't go to VC and fringe investments because they're giving to charity. They have all the other charities to do that for. So I think, and I might throw up in my mouth a little bit when I say this, I think organizations need to be set up that raise money, particularly focused on building cash flowing companies. And we don't promise crazy returns. I would love to see I think this is called private equity, a kind of a version of private equity that doesn't just do the buy sell, but it's like we're going to amass portfolios of cash flowing amazing companies and give our investors dividends over the course of the fund, over the course of all the things.
So that's right. I think you're talking about a private equity type point, because in order to get the right kind of dividends, you're going to have to own more than 10% of the company. In theory, you could, but it's, if you're trying to grab the cash when the company distributes cash, you want something worthwhile. You're talking about, minority stakes to majority stakes, probably not management majority, but minority stakes in companies.
Yeah, I would say minority, but it's also creativity involved in deals where you could still get paid even if you don't own any money, right? I mean,
That's
own
right.
any equity. So it's like we can. That's what excites me about capital allocations, is that there's an opportunity to create a new kind of VC, a VC that behaves like a PE that is focused on the fringe, but it's fringe that cash flows. So deep tech may not get a nod. Things that take 10 years to build may not get a nod, but things that can become ATMs in 3 to 4 years, that's worthy.
Yeah, I think this is where it butts up against.
You said but.
Ass, I was saying.
You said ass.
we crack each other up. All right.
Oh, you're getting cheeky. You're getting cheeky. Oh, you know what my favorite song is? You know what my favorite Brown Eye Girl. That's right, Zach. You got it. Hey, why don't we go? Anyway, what the hell were you saying? I forgot. I'm completely lost interest. Completely lost interest.
The so right, when you talk about cash flow positive companies or profitable companies, that also doesn't mean you have to return cash on cash dividends to folks. It can mean that the company itself has built a sustainable model where they reinvest capital into themselves and continue to grow market presence and impact as a company. And so that in years 9 and 10, the outlier years, that's when you can have outsized returns. But what happens is you're investing in companies early where they're still burning cash in the first, let's say 1 to 3 to 4 years. You're looking for companies in years 4 to 8 that pivot over into cash flow positive, and in years 9 and 10 return significant amount of cash and other dividends to investors, right?
Yep.
Like that's a hybrid model where I think more investors should look at it as an investment class. And I think there's going to be a level of boring businesses that still have the opportunity to be disrupted by technologies. I think of companies like Company Cam, who work with contractors to like log and track pictures of job sites and allow for multiple sites to be managed through just this curation of visual images. And it's not profound, but it's $100 million company.
Yeah.
Right. And I think that you can allow venture capital continue to have the mob. I just don't know how you reform a mob. When a group comes to you and says like, we're a mob and we believe the election was rigged, like all you can do is like fight or ignore the mob, but you can't change it. Go
Uh,
you can't
yeah.
go in the middle of January 5th and tell everybody everything's cool and the mob go, all right, yeah,
No,
we
you know
see
what?
what you're coming from.
No,
No,
you're right.
you either ignore it or fight it.
Yeah.
And so like with venture capital, you either have to show up and fight them and you have to like uh
Ah,
push them in a certain way, or you ignore them and you build your own thing.
yeah, and that's a lot of effort, right? When what was going through my head when you were talking, I'm like, man, I wonder what I'm going to have for lunch. And then I got re-engaged, and I was like, do I even care? I was like, because I do want to see capital allocations change, but I'm trying to be honest with myself. Do I care about the state of the VC market, or do I care about my companies and my projects getting funded? And do I care about me being able to attract the right kind of limited partners for the kind of funds that I personally want to build? Right.
Mm-hmm.
And I think I'm landing in I'm going to ignore these people camp. I'm going to ignore the mob. I'm going to build VC mission fringe base investments that operate more like PE than VC, and I'm just gonna go and do it. And then at the end of the day, people can be like, "Hey, that'd be great. What are your returns?" I'm like, "Oh no, my investors, no matter what's going on, they're making money because we bet on profitable businesses, and they just keep making money."
Yeah, or what you do is you define a new hurdle rate, right? So
Ooh, that's smart.
all of your investors, let's say it's a $10 million fund, 10 people put in $1 million. Well, um there might be a hurdle rate for you to get paid. Like you don't get paid for a hire instead of a 20% split. You're like, or you can do a 1x participating with them. I mean, there are funds that do this right now, but
Mm-hmm.
maybe you just say like, hey, what we're going to do is put cash distributions on the table and we're going to work in the first 5 years of the fund to get you back your principal.
Yeah.
So everybody gets their $1 million back and we're going to hold equity positions and then we're going to play with house money for the second half of the fund. Or you create a 20-year fund horizon. There's no rule against it, and you just say, hey, we're going to build, this is essentially a fund in 3 or 4 stages. And you
Yeah.
do it that way. I mean, you could say like, there's enough people out there who have that kind of liquidity available, especially in like family offices, and they have that horizon capability. And so you say like, it's for your grandkids. You're planting trees you'll never sit under in the
Mm-hmm.
shade, but you know, you're in it. You're going to spend a lot of time figuring this out in the economy, but you're like, it also allows us to be divorced from all the macro trends.
Yeah.
We can literally pick businesses with high profitability in certain sectors that are just going to be rock stars. Like, um, think about like your whiskey, your space whiskey,
I,
right?
I I never stopped thinking about that.
Like it can. There's some milestones that you could achieve in 2023, right? Like as far as like distillation of product and proof of concept and all sorts of really cool things. But when you talk about like international branding, reputation, distribution, selling these bottles for $1 million in China, like when you think about that, that's a long road to walk. That's 4 or 5 years, right?
Yeah, 3. Yeah.
Well, I mean, I'm suggesting that like your outsized returns are, and you're
Yeah.
like
Yeah.
you can become a great profitable business and make millions of dollars, but if the first time your first bottle sells for $1 million, just one bottle, like that's a milestone, and that might be a ways out, but like just because of the infrastructure it takes,
Yeah.
and
Yeah.
so um, I I think of things like that. Like, does space whiskey disrupt anything? No, not per se. It can change the way we think about distillation and alcohol and a number of other chemical processes in space. It can change all that, I'm sure. Um, but what it does at the commercial level, right, is not deep tech AI.
Mm-mm.
It's selling a bottle to every venture capital group in the Bay Area so that they have it on
I,
their shelf.
I need 100 clients. I don't have to do complex branding. I don't have to do, it's like building companies that are designed for massive profitability that don't necessarily have to be around forever. Right. I
Mhm.
mean, and I mean, Space Whiskey is a great example because the real purpose of Space Whiskey is to demonstrate that killer app for orbital manufacturing, right? What can we use space manufacturing for? And it is slow capital, right? If you want to build the next International Space Station, not a lot of people are going to be like biting off of that apple, right? That is a hefty thing. Lockheed Martin and Nanoracks we're going to have something up there. China's putting something up there. That's a big thing. And whenever you think about a particular market and you see, oh my gosh, it's going to take 10 to 15 to 20 years to see returns, if ever, which is kind of like the space economy is right now. The idea is if you can disrupt it by changing the business model and start, and it's kind of what you've been saying all along, the big disruption is cash flow. So if you can demonstrate that there's a market that is experiencing slow capital and then show a way that they can have fast capital where they can actually cash flow their investments and they can get their money back. Like you said, hey, we're gonna get you your money back in 4 to 5 years. It's going to be amazing. And then you still own equity and you still get to ride the ride and we're playing with house money. I think that's the big innovation. I think that's the message that people love is, hey, we're going to cash flow complex things. But yeah, it doesn't fit the model for VCs. It's one of the reasons that we're not taking Space Whiskey
Yeah.
Corp to venture capital.
Well, and that's right, because the mob mentality is yet to settle down, right?
Yeah.
They don't know what their valuations are. They don't know what they're into or not. They're going to have prerogatives around B2B SaaS or fintech or healthcare tech, and like, where does frontier space fit in with consumer packaged direct to consumer goods, right? Like, there's no LPs out there that are putting money into a fund saying go find these things.
Not yet, baby.
So I think you're right to say that this is a manufacturing play,
That's all it
right?
is.
And but even then, manufacturing has such a capex to it that like if you're really going to spend money and not see returns for a capital X investment, you might as well be in healthcare and medical devices. So like the trade-offs are just so hard for venture capital to justify that they're like their mob mentality is not about the trees, it's the forest. They can't see the trees. And so they're like, well, what's really important right now is Chat GPT and your AI capability and how you're going to disrupt
dude,
the disruptors.
I looked at a deck for an identity management, password automation, access management security platform yesterday or 2 days ago. And, I get it. I know the guy's technology is going to do it. We get to the end. We get to not the end. I stopped him halfway. I say, you see where that says AI? I say, stop lying to me. Put machine learning. I'm just done with this. I was like, never mind. My emotional reaction to everyone talking about AI, which is not AI, it's stupid machine learning. That's all we're doing. But then I realized I was an old curmudgeon who was angry about like, you can't call it cloud computing. It's called a wide area network, right? So it's like, maybe it's me, but I have such an emotional reaction to buzzwords being the thing that make people make decisions. And I think that's one of the reasons why it's frustrating pitching to VCs who don't understand your industry. They don't understand what you're doing. Is all they know how to do is listen to the buzzwords, and all they can do is compare and contrast what you're doing compared to everyone else. So they're fish in a school, and when they turn, all the other VCs turn with the mobs. They just think that every other industry is exactly the same way. Well, you've got 17 other companies that are going like this. How are you going to beat them at that game? You're like, oh, bro, I'm trying to play a different game. Don't put me with those fish. I'm going to the right. They're going left. Left is wrong. Nope. 17 of them, they got to be right. So we're going to bet on the people who are going that way. And so innovation actually doesn't happen. Fringe investment actually doesn't happen. And we double down. And this is why we get these huge waves of success and failure. Because when the mob decides to go a particular direction and they invest in other mob type industries, great deal of success. When they find out they're wrong, everybody fails.
Mm-hmm. That's right. Yeah, I don't know when the mob will flip. Like I said, there are some VCs out there who think for themselves, have independent thesis. Their analysis has no concern with what other third-party externalities have to do with their deal. They consider the deal purely on its merits, on the market, on the opportunity in front of them. They ask themselves, do we want to be in this? And is this something that if we're in this will one day grow for us? And like I said, I actually think the top tier VCs have this magic in them to be able to do just that. And and they are the thought leaders in some regard, that when they say out something to the rest of the VC world, other people pay attention. And so they will share out some of their magic, some of their thoughts, and they will get VCs who want to follow on to their deals to continue to follow on. But the majority of VCs that I have come across, especially regional VCs, they're not like I said, there's so little reason for them to write a check right now until everybody else in their industry tells them where to write a check. They're just not going to.
Yeah.
So the founders who are operators, especially metric driven, tell me how high to jump and I'll jump that high. The founders who did that, which I'll say we're one of them at Hook.
Mm-hmm.
We're the ones left out. We put trust in a mob that we couldn't control. And so,
well, and also we believed the guy who was standing in front of the mob screaming things. Right. So let's pivot. Let's pivot a little bit here in our conversation. By the way, pivot's a nice word that VCs use too. It's some few you can. Should we do that? Should we create an online learning course for TSOB?
I was thinking about calling our podcast Pivot or Pivotcast, and like a way for us to pivot away from the pod, and just like that's where I want to go. I want. Anyway, like we were talking about, we want to be popular like the All In podcast, and so
that's it.
What we're gonna do.
Yeah, what I want. Hey, but did that fish turn? Should we follow it?
Yeah, we're gonna. I think if we pivot to begin to act like everybody else, then that would be our true innovation.
So our tagline, fuck that bird. Right. So for our first time listeners, it's 2 stones, 1 bird. Fuck that bird. And we don't have that tagline anywhere. And I'm wondering if we should. I wonder if the only way to differentiate ourselves from the pack is, rather than be intelligent, smart people who come up with clear, well thought out conversations, we just do shock value stuff. Is that the right answer?
VC shock jocks.
Yeah, that's right. Hey, what's up, man? Anyway, so sports ball, let's go.
As you're all on your morning commute, traffic is bad out there, but we wanted to talk about markups.
What?
Internal rate of return coming right at you, bitches.
You know what? Let's talk about. No, I'm going to do the rest of the podcast like this. Okay, here we go. Because we're about to talk about Reg C versus Reg B and all this other stuff. Mm-hmm. Okay. What up, bitches? Are you starting a company or a fund and you want to raise money? What? That's crazy. How are you going to let anybody know about it? The SEC losers.
Yeah, so I was about ready to say, I think we got the joke.
Okay. Do I get, but
No,
I
no,
could,
you can keep,
I got the next 14 minutes.
you can
I,
keep, I'm just letting you know, Stitch incoming.
oh,
That's a TikTok thing.
oh.
We got-
So, yes, let's talk about different ways to raise money. Because if you're not going to go to a VC, one of the things that's great about VCs is that you're allowed to go talk to them. You can say, "Hey, I got a business. Please give me money." And if it works and the relationships happen, they give you money. So if you can't go to them, who do you go to? Well, friends, family, and fools, right? So that is a kind of a Reg B. What is the actual reg? I think it's 506B. Yes, 506B, that lets you go to people you have previous relationships with where you can vouch with them and they do not have to prove that they are accredited investors. They do it themselves. It's a self, whatever. Self-assessment.
Attestation.
There you go. And so you can do that, but you're not allowed to let other people know about it. So if you have an extensive network, great, go ahead and do that. And so with the SPV,
Wait, are you saying there's a regulation for Good Old Boys Club, and it literally says if you're in a Good Old Boys Club, you don't have to invite anybody else in. Nobody else has to put their capital into these private deals, so you have no competition.
That's correct. But you forget that you made it sound like a bad thing. So it's not. What it is you were protecting grandma, because the normal human is stupid according to the SEC, and they have no way of understanding how markets work. I mean, look at GameStop.
I think that's exactly right. I think this idea that the greatest way to generate true wealth beyond income is owning private equity.
Yeah.
Period. In human history. And we have locked that down to people who already have demonstrated that they have raised capital, they have access to liquidity levels, and it is garbage. It is like only allowing people who previously inherited like BMWs to have driver's license. And it locks everybody else out from the true commerce. And that doesn't mean everybody should participate. I do think there should be a driver's license level test, but it should not be based on income. It should not be based on your family lineage or access to other capital. It should be based purely on your understanding of a market. Get a driver's license and then have at it. That's exactly what I believe. Sorry, it is a soapbox of mine. Go on, tell it. So Reg B is the Good Old Boys Club.
Yep.
I get it. Yes.
So Reg, and the whole reason is, hey, Ponzi scheme. Don't steal grandma's mom. Don't steal grandma's mom. Please don't steal great grandma. But the other side of the house is, hey, look, there are a lot of people out there who want to invest in your project, and you need to be able to talk to them. And so what I have discovered is that there are people who would invest in this SPV if they could hear about it. And by the way, we haven't filed our Reg B yet, so I can't talk about any of this stuff right now about the actual details. Stay tuned to the next episode where Adam tells you all the things. And so, our compliance guy, Josh, is like, hey, let's just go Reg C, I believe it is. Yes, Reg C, 506C. And he's like, that means you can do general solicitation. That means you can put on LinkedIn, hey guys, I'm raising money. You can create ads. You can do whatever you want. And the reason is, this is different than crowdfunding. This isn't, because you can still only take money from accredited investors. So a Reg B means the investor has some relation with you, and they have to prove they don't have to prove they're accredited. The Reg C is they don't have to have a relationship with you, but they have to prove they're accredited. And the way you do that is we have a form letter, a sample template, and then you give it to your CPA and they sign it and they send it back. That's it. That's how you prove it. Some third party that you are paying says you got the money. So it's a really good system. Anyway, so it's kind of exciting, right? Because remember when we first were starting to raise money for hook, and I was just going to blast it to everybody. I was like, dude, man, we got all this stuff. And our compliance guy at the time was like, you're going to get us. We're all going to die.
Yes.
And we're like, bro, what? How else are we going to let anybody know about it? So I've complained about this to my compliance guy, and he gave me some wisdom. He said the SEC doesn't care if your company gets funded. The SEC doesn't value anything that you're doing. The SEC is there to keep the money flowing the way that it's currently flowing, and these regs are in place to make sure that that happens. And so I don't think I will ever do a Reg B again. I think I will always build companies that are Reg C. It will cost a little bit more, and it takes a little bit more time, and it's a little bit more complicated. But it's like I was on a podcast the other day, and I couldn't talk about the cool thing I was doing because I had the wrong regs. Right. So yeah, this stuff's important. Yeah, I definitely think we need to put together a TSOB version of, 101, capital allocation 101. And we need to be hilarious at it. We don't need to be.
Mm.
And matter of fact, we should teach at least 20% of it wrong. Intentionally.
You got comment below on what we got wrong in today's episode.
That's right.
I've been thinking about something similar. I don't know about Reg C as I've been thinking about absolute crowdfunding. The issue with crowdfunding is it's like trying to sell your consumer product, right? And like all fundraising is sales. But I would say the things that seem to be working right now on crowdfunding sites have an emotional narrative and story to them that either make somebody's life easier or solve a problem. And it's like GoFundMe for companies. And it just takes a lot to build that kind of virality to raise significant funds on crowdfunding sites, that kind of persistence. So you're in a marketing and sales role when you go into crowdfunding spaces right now. But I'm optimistic that it will work out better. I've not personally written checks onto crowdfunding sites before. I think I've done a Kickstarter once or twice.
Yeah,
But
same.
I think that's where I'm going to head in the next quarter or two, is to get on a couple of these crowdfunding sites, figure out what fits me, and I will actually write checks and
Yeah.
write maybe $1,000, maybe $2,000 or $3,000 checks here and there, and see experiences like as an investor, and then leverage my network to invite them to participate in a certain kind of crowdfunding for future raises. And then we have like a special project incubating at Hook that I think is going to do really well crowdfunding. And because it has a narrative, it has a story, it has an emotional line to it that I think could really get out and resonate with people. And I also think it'll be the best thing for the actual product line if 1,000 or 2,000 people are aware and getting the updates and enjoy the behind the scenes.
Yeah.
That
Well, I think you're right, because it's a selling tool at that point too, right? Crowdfunding is an amazing thing. Although if you went rewind about 3 or 4 years ago, I'd be like, man, venture capital is an amazing thing. So we don't know what we don't know about crowdfunding yet, but I have a call at 4:00 today to talk through all of that, to see what it's like. Because your company should be funded by people who believe in your company, who deeply understand it and are passionate about it. I think it matters where the money comes from. And there's different levels of this, right? You can absolutely take dumb money and go to town, but then you're going to always be measured based off of the success of your balance sheet and your returns and your P&Ls and all that, right? And so you don't have the luxury not to build a super profitable, fast company that all the promises, right? All the the problems and the promises. If the people who are investing in your project care about it, then there's other KPIs to measure, right? For people who are going to invest in Space Whiskey, they're going to care that we set world records. They're going to care that we're moving manufacturing forward, and they're going to care that we're creating intellectual property that we're going to be able to license to other people. They're going to care about all that stuff. It's not just going to be, have you sold that first bottle yet? Now that is important. You still have to build a company that works, but finding LPs that can celebrate your small successes along the way because they're super passionate about it. I like the idea that person could be a person who writes a check for $100, and it doesn't have to be a person who's writing a check for $1 million. I like that a lot.
Yeah, I've nothing to add to that.
That was a good soundbite. I think we should totally cut that up into like some content, and I should put that online.
Yeah, we should totally post this stuff online somewhere.
Oh my gosh. So when are we going to put this thing on iTunes, man? Because hey, hello, listeners. We have, we're on Spotify and we're on YouTube, and it's all great. Also, I kind of feel like we're not a real podcast until we're on iTunes.
No, we're probably not. How about you and I, when we meet in person in the next coming weeks, we spend some time going over all the things. I think we should have a launch party.
I do too.
And,
Where?
I don't know. Maybe we have it at multiple places.
Dude, we're not going to do this, but I want to do this. I just saw a rickshaw race. So like, if you want to see the Himalayas, picture it. They call it a rickshaw. I thought that's a thing you pull. This is like a tuk-tuk. This is like a little crappy motorcycle with 2 seats in the back, like what we experience all over Thailand. And you and 2 of your friends have to take one of these things and go through the Himalayas. And it's
is that a real adventure?
That is a real thing. And it's like, there's only 3 things that's going to happen. 1, you will break down. 2, you will get lost. And 3, you will get stuck. Those are the only things we can promise. So what if our first conference was, and maybe we don't go to Himalayas, but why don't we just get a bunch of $200, tuk-tuks, and we do like a road trip through someplace pleasant, right? And that just makes me happy to think the kind of people who would show up for that would be our kind of people. What are we talking about? We're riding these tuk-tuks through Panama City, and we're talking VC. What's up? We're capital allocators and entrepreneurs. Way.
Yes, we narrow down our audience to 1 person in the United States.
This is Tom.
The only guy that cares about the intersection of these 3 things.
That's right. This is Tom. Actually, no, his name's Brian. Brian's out of Clearwater, and he sent me the thing. He's like, we have to do this, and he's doing fine. He's well off, but no, I think we should do that. I think we need to have a launch party, and maybe the tuk-tuk thing is for the end of 2023, because I think if you're going to be in that, you should be in like the Northeast in winter, trying to get through snowbanks in a thing that weighs like 12 pounds.
That's funny. I love it.
All right.
I do have to roll. You do your awesome thing. And it was another great episode of 2 Stones, 1 Bird. Appreciate it.
See you, Zach. Bye.
See ya.
Hey, and thanks for joining us for the TSOB podcast. Find us on LinkedIn and give us your hot take. The whole reason we're doing this is to get access to better conversations that help us up our game. And if you have something you want to share, we want to hear about it. Find us on the TSOB LinkedIn group and jump in with 2 feet. We can't wait to chat.